How to Invest in 2022 Beginner Friendly Guide. So, you want to learn how to invest in 2022 but don't know where to start? If you're interested in making money through investments, there are many ways you can do it, but there are only a few ways that can make profits. Most beginners think investing is a sure way to get financial success overnight. But let's be honest, getting your desired result is not easy. Just starting to invest is already a big challenge, as it's easy to get confused, lost, or overwhelmed with the amount of information you need to know about investing. The first step to successful investing is choosing the right fund to invest in. In this video, I'll tell you how to invest with the three most popular financial assets. Keep watching this video if you want to jumpstart your investing journey. Hi there! Welcome to Make Wire. In this channel, I'll show you the best tips and tricks in the financial spaces, business, and entrepreneurship. Make Wired is created to help as many people as possible make money online from the comfort of their homes. Just sit back, relax, and learn how to make money work for you. Be sure to subscribe to my channel and hit the notification bell so you're always updated with my latest videos. Are you a newbie in investing? Or have you always been involved in this trade? Whether you're a newbie or an expert, there's always something new to learn about investing. When we talk about this trade, we must be always in the know with the latest trends and updates. As a newbie, it might be challenging to distinguish between the various investment possibilities that are worthwhile and those that aren't. When I first started researching investing, it was difficult for me to tell good investment paths from bad. I was unfamiliar with the meaning of the various financial words that I would hear when discussing stocks and bonds. I then educated myself with these terms and became aware of the importance of diversity and how it may help you spread your risk. In essence, diversifying will spare you the agony of losing everything if the company you invest in fails. For a risk-averse investor like myself, not losing all of my hard-earned money seemed a great approach. So, I concentrated my investing efforts on three specific fund types: index funds, mutual funds, and exchange-traded funds or ETFs. Let me explain these three types of funds and how you can utilize them to increase your wealth because they have provided me with excellent returns over the years. What exactly is a mutual fund then? A mutual fund collects various securities such as bonds and stocks. Because they lack the ability or time to build and maintain such a diversified portfolio, investors typically hire an investment firm to handle this collection of assets. An annual fee of about 1% of the invested amount is levied to the investor using a mutual fund. This implies that for every $20,000 an investor invests, they will be charged $200. As with most stock funds, the portfolio manager chooses the assets solely based on his or her predictions of which stocks would do well. This process is called active management. Index funds are the following. Comparing index funds to mutual funds is a different method. In this instance, the portfolio manager buys all the stocks in a specific index, rather than just selecting the firms they think will perform well. Examples are the Russell 2000 Index of small stock businesses or the Standard & Poor's 500 Index of equities from giant companies. Index funds are designed to mimic a market's performance as a whole. Since index funds are bought and held, they have low operating costs and little need for outside management. For instance, the Schwab S&P 500 index levies a 0.02 fee on each investment total, which translates to a $2 fee for every $10,000 invested. You can only expect to profit from owning all the stocks in a market if those stocks are all in that market. This could seem unpleasant to someone unfamiliar with the stock market, yet many seasoned investors find it enticing. According to studies, it is difficult for funds to maintain a competitive edge in the market due to the high costs associated with active management and the difficulty in reliably predicting which stocks would perform well or poorly. One significant advantage that index funds have over mutual funds is this: ETFs, or exchange traded funds, third option for beginners. An ETF is a specific index fund that fund firms do not offer directly. Instead, they are listed on the exchange. And to buy and sell stocks, you must maintain a brokerage account because they are required a commission each time they wanted to trade. ETFs used to be expensive for investors who wanted to hold them for an extended period. However, since many online brokers now provide free trades to their clients on stocks and ETFs, this has started to change recently. Now that you know what each of these funds is made up of, it's time to discuss their benefits and drawbacks so you can choose the right one for you when you begin your investment adventure. Starting with the benefits of mutual funds. The diversification of risks is the first benefit of mutual funds. Every share of stock carries three categories of risk: market risk, sector risk, and business risk. Market risk is classified as systematic risk, while firm and sector risk is considered unsystematic risk. Whether or not market prices rise, a company's stock price may decline if they are not doing well financially. However, even if the business is doing well financially, the price of the company's stock may still plummet if the market crashes. With mutual funds, investors can explore several industries and invest in diversified portfolios within them to avoid unsystematic risks. The lower capital expenditures are mutual funds' second benefit. By pooling the funds of individual investors, mutual funds enable each investor to make a smaller initial capital investment. In the end, this lowers the investor's overall risk. With mutual funds, investors can have a varied portfolio with a slightly smaller capital expenditure than they would typically need to hold a diverse portfolio of equities. The third benefit is investment proficiency, which comes with years of experience and expertise in the stock market. When investing in mutual funds, specialists are engaged to manage the funds, and these experts can identify stocks with long and short-term profit potential. The fourth benefit is the reduction in transaction costs and economies of scale. Investors in mutual funds can make significant financial savings by engaging in transactions on a per-unit basis. Due to the volume of securities that mutual funds transact, transaction costs are significantly cheaper for each unit of investment than for investors using a stockbroker. The range of products available is the fifth benefit. Investors are presented with a selection of products through mutual funds tailored to their risk profiles and investment objectives. Along with equity funds, there are liquid funds, balanced funds, and monthly income plans. Solutions will satisfy a range of investing needs. The various investment options are mutual funds' final benefit. Mutual funds offer investors an advantage in terms of investing and withdrawal method flexibility. Investors have different investment options, such as lump sum systematic investment plans, systematic transfer plans from other mutual fund schemes, and growth mutual fund options for individuals interested in compound returns over the long run. Alternatively, if you desire consistent short term returns on your investment, you might invest in dividend options. In the stock market, no other investment products offer such a wide range of investment options. As you can see, there are many benefits to investing in mutual funds, but we must also consider the drawbacks. The first of which is that you have little influence over your portfolio. When you invest in mutual funds, you cede power to reputable professionals tasked with executing the best trades on your behalf. Then there are capital gains, which are taxed when equities are traded. With mutual funds, however, investors are taxed when the funds distribute gains from the trade of individual holdings, even if you didn't sell your own. Finally, there is over diversification. Having a well diversified portfolio lowers the risk of suffering a loss. Still, it may also result in a potential decline in profits. The influence on an investor's portfolio would be less noticeable the more securities they buy. Moving on, there are numerous benefits to investing in index funds. Here are the top three. Diversification offers a wide range of protection. With index funds, you may diversify your portfolio well, which reduces the danger of losing all of your investment capital by placing your eggs in multiple baskets. If one of these baskets were to fall, you would only lose a small portion of your eggs. The low prices are the next factor. For those new to this subject, there is a concept known as an expense ratio. All fund holders must pay an annual fee known as the expense ratio. This represents a percentage of the investment's total assets. Typically, this is a very modest amount of money. For instance, if you placed $1,000 in a mutual fund with a 1% expense ratio, you would need to pay an additional $10 a year to own it. The return in comparison to actively managed funds is the last factor. History has shown that the most knowledgeable and skillful portfolio managers cannot create actively managed mutual funds that outperform index funds. According to data, just 23.51 actively managed mutual funds have outperformed the S&P 500 during the past 5 years. Market capitalization weighting is the first disadvantage of investing in index funds. Similar to mutual funds, suppose a Wall Street expert forecasts that Microsoft's stock price will rise and that professional investors will purchase the stock. Index funds will allocate more capital to purchases than Microsoft stocks because the market capitalization of Microsoft increases with the stock price. In reality, this contributes to index funds' final law, which is their lack of responsibility. Over the next 10 years, it is predicted that robot index funds will make up more than half of the American stock market. The sad issue is that if everyone owns small portions of each business, who will be responsible when something goes wrong? ETFs are the last sort of fund, and the following are their advantages and disadvantages. The first benefit is the trading and flexibility it provides. ETF trading allows for almost immediate money transfers between various asset classes. Risk management and portfolio diversification come next. ETFs have grown in popularity over time and are widely traded on virtually all essential asset classes and currencies worldwide. Items include the British pound, the Australian dollar, and the Japanese yen. Finally, fees for ETFs are often modest. Open-end mutual funds have higher operating costs than exchange-traded funds, ETFs. The reason is that the brokerage firm that holds the exchange-traded stocks in customer accounts often bears the cost of any client service-related fees. ETFs have one significant disadvantage when compared to other types, which is when there is a tracking inaccuracy. You must be aware of the underlying security that the ETF is tracking before you purchase it. Following this, there will be some tracking inaccuracies that you must accept. This eventually means that the performance of the ETF is different from that of its underlying equities or benchmarks. There are numerous causes of tracking errors. One of these is variations in timing, while rebalancing the underlying portfolio offers and bids. By comparing the ETF's tracking error to its benchmarks over the past few years, you can safeguard yourself from this. So, those are the advantages and disadvantages of the three funds most suitable for beginners. It is now up to you to balance the advantages and disadvantages to decide which is best for you. Now that you know the basics of investing, you can jumpstart your investing journey more confidently. What financial topics do you want to learn next? Let me know in the comments so we can cover them next time. Thanks for watching this video. If you like this video, share it with your family and friends so they can also make money online. See you later!